BSP confirmed the 25 basis point rate cut last week, while the S&P 500 reaching new all-time highs amid extreme market greed. Could we be headed for a late dip in October? Let's discuss. My name is Den Slim, and welcome to another episode of Monday Market Outlook. Finally, the BSP came through with the expected 25 basis point rate cut at their October 16 Monetary Board meeting. Actually, this was supposed to be on October 17, but for some reason, they changed it to October 16. And while this was largely expected, the BSP chief further signaled the possibility of another 25 basis point rate cut in their last meeting on December 19. If realized, this would bring the benchmark rate to 5.75% by the end of 2024. Now, Mr. Remolona also said that a 50 basis point rate cut in December was unlikely, and the only reason to do so would be a scenario where, quote-unquote, we see a hard landing. And of course, based on projections, yes, I do agree that this is very unlikely. For 2025, though, the governor expressed the possibility of a 100 basis point cut, but on the dovish side, and the board would prefer to take baby steps in terms of policy rate adjustment. So what this basically means is that 100 basis point being dovish it's on the generous side, meaning it is more likely that the cuts may not even reach 100 basis points next year. So just to put this in context, the rate cuts will not happen as fast as they were hiked, right? The slope of rate hikes here will not be the same as the slope of rate cuts going down. In other words, this is not going to happen as fast. So we will have a more controlled decline over the years in terms of rate cuts, which also means that we cannot expect property stocks to rally, to go up as aggressively as they went down. So this is probably why property stocks are consolidating along this area, because a more aggressive rate cut was expected earlier in the year, and this resulted into an exaggerated run up. So property issues may continue to consolidate for a few weeks given the news from the BSP. Now, which is also why banks are hanging on to all-time highs, as they will continue to enjoy large net interest margins longer than expected. See how everybody thought rates were going to get cut last year. The banks went down, but instead rates actually went up. So the market realigned, and as a result, banking stocks having another great year. Speaking of great years for banks, earnings season kicked off last week with BPI providing the starting gun. Net profit up by 29.4%. That's the highest quarterly profit to date, and the 9-month earning of BPI is up 24% year on year. So could BPI results be the proxy for the succeeding bank earnings in the coming weeks? Meanwhile, loan growth from banks may be up, but they're not being spent on cars. More than 39,000 cars were sold last month, but it was only up 2.4% in September, which is the slowest growth since March this year. So perhaps we could see renewed consumer spending in the coming months as consumer stocks continue their solid growth last month, with financials and utilities also doing well. Property stocks are lagging for now. Meanwhile, China GDP came out last week to its lowest GDP growth in a year, but this was better than expected. GDP clocked in at 4.6%, led by industrial output and retail sales. So imagine 4.6 GDP is the slowest GDP for China. But the data was on the whole better than economics has been forecasting, and probably this could mark a turnaround in the Chinese economy. But prices for new and existing homes fell faster compared to a year ago. Sales are down 24% in the first 9 months of 2024, with second-hand home sales at negative 10% this year so far. Hang Seng Index celebrated GDP growth numbers, gaining almost 4% last Friday. Hopefully, by the time China turns around, the Senate has wrapped up all of this POGO issue, and the Philippines can become again an attractive destination for Chinese tourists, which will benefit the likes of airlines, casinos, and maybe even malls. Perhaps this was why Bloom was the second highest foreign bond issue last Friday, up 1.6%. In the meantime, the ECB has cut interest rates back-to-back, cutting rates by 25 basis points to bring the key deposit rate down to 3.25%. What prompted this cut was the unexpected decline in inflation, easing from 2.2% to 1.7% in what Christine Lagarde describes as a downside risk to inflation. So just a quick note about economics and inflation, right? Inflation going down isn't necessarily a good thing. So inflation going down because rice prices are going down, gas prices are going down. It's good, right? It's input cost. But inflation can also go down because demand is down, right? So when economic activity in a country is down, how can you raise prices, right? So as a business owner, for example, if you own a business, right, you have products on the shelves. If nobody's buying, what are you going to do? What do you usually do, right? You introduce sales, you reduce price, 10% off, promos, etc. So basically, you're bringing the price down of your product so that you can push it out of the shelves. So with less economic activity, inflation is naturally low, right? So this is what's happening in the European Union right now. Economic activity has unexpectedly slowed down more than expected, which is why inflation also went down unexpectedly. And that's what a downside risk to inflation means. So with economic activity slowing down in the EU, perhaps Southeast Asian equities will become more attractive. So we'll see, right? But while EU inflation is down, the market's starting to price in higher long-term inflation expectation in the next 5 years, because as you bring down interest rates, as you bring down borrowing costs, people start spending more money. And of course, when economic activity starts going up, prices do tend to also go up, and thus inflation also go up. Plus, with the geopolitical tensions in the Middle East, if oil prices go up, of course, that could also be a factor moving forward. And while oil prices have stabilized for now, the markets can be jittery and oil prices can spike up anytime. So with inflation fear still looming, the US 10-year yields continue to rally. The next level of resistance is at 4.193, which we still have some upside to go. And with the 10-year yields and the DXY rallying, the peso continues to fall, closing in at 57.48 last Friday. But recent events in the Middle East could provide some stimulus in the markets as Israel confirms the death of the Hamas mastermind behind the October 7 attacks. And this could lead to a rare opportunity to strike a ceasefire. So we'll see how this news affects the markets this week. But let's look at the PSEI charts. The index ended the week at 7,400 after making a few attempts to reach the 7,480 level. Last week, the market consistently opened strong but weakened by the close for the last 3 days. Although the BSP's decision was largely anticipated, the outlook for potentially more aggressive rate cuts next year tempered market enthusiasm. So far, the market is still holding well along the trend line support here, and the brief dip into the 20-day EMA attracted bullish demand, pushing the index up 1.5% last Tuesday. This momentum kept the local markets in positive territory for the week. So let's look at some stock highlights. These are the stocks I'm monitoring for this week. AC, a good consolidation along this resistance range. I'm still hoping that AC could dip to the 20 AMA, which would provide a good buying opportunity. And if you look at the longer term charts, AC is right there at a very strong resistance band. But if it breaks out of there, you see the next resistance would be at 770, and then we have 820, 830, we have 871, we have 900, and we can even reach up to around 1,000. So the upside here clearly better than SMs. If we look at SM, see how it is already at 1,000 and we have the next upside at 1,100. So this is just 10% upside compared to AC with a much bigger room to grow, which is probably why foreign buying is concentrated on AC more than SM. So meanwhile, DMC already announced its dividend at 48 cents. And this was largely expected to be lesser than the 72 cents prior. So the ex-date, October 29, if you are a long-term dividend hold on DMC, the week after October 29 could present a gap down and a good buying opportunity. So let's look at property stocks. I'm still waiting for Ali to dip to 34.70. Best if it dips to 33.40, which will still keep its bullish momentum intact. Right now, Ali is consolidating above the 100 EMA. Let's see if it gives us an opportunity this week to buy into Ali. SMPH also just hugging the trend line here. Again, for real estate stocks, the run-up may be tempered right now given the hawkish stance for the BSP. Meanwhile, RLC, classic breakout retest of support. This could be a good opportunity to enter RLC. Of course, REITs also went down because of the pronouncements for rate cuts next year, but technically still looking like a breakout and a retest of support. This could probably be a good opportunity to buy a REIT also, but of course, I would prefer buying a REIT at around 36.50 or even lower. RCR, also a private placement, pushed RCR price back down to 6 pesos. This could be a good buying opportunity for RCR. Meanwhile, I'm also looking at consumer stocks, right? Monde still looking good. Also, Keeper is your sleeper stock this year. If it dips to the 20 EMA, that could be a good buying opportunity. Now, I'm holding off on banks for now as I think that they have had a good run up, and of course, I'm just letting my banking issues run given the great earnings report. And lastly, of course, also looking at utilities, AP at 37.90, touching the 20 EMA, could also be a good buying opportunity. Manila Water looking very weak, 26.60. It can go down to 26.50, 26.40. For me, still a good long-term hold, but watch for its reaction along this area. Could it dip to the support at 25.50? We'll see. It could be another good buying opportunity. So for this week, I believe that the market still has some potential for an upward move. If we look at the Bollinger Bands, the market currently holding the support line here and hasn't become overstretched, indicating some flexibility for future gains. However, there is also the possibility of a downside move towards 7,274. So on to the global markets. Let's look at the S&P 500. The S&P 500 hit another all-time high last Monday but gave up those gains following the ASML earnings report. The index then stabilized for the remainder of the week, closing strong and marking its 6th consecutive week of gains. At this point, I'm observing some signals of caution such as divergences on the RSI. The RSI hasn't made new highs as well as the MACD. So some divergence there. And if we look at previous candlestick patterns, this bearish engulfing candle here, similar to this, and then 3 candles run up, a rejection wick here. Could we have another all-time high before a subsequent sell-off? It's important to note that October remains the weakest month for the S&P 500 with the presidential elections 3 weeks away, and with bullish sentiment at dangerously high levels. Could this be a setup for a market correction? Key levels to watch are 5,790 and 5,700. If the bulls are able to defend this zone, then we can continue the rally. If these levels are breached, we might start targeting further support zones at around 5,600 and 5,470. Now, let's look at the sectoral performance over the last quarter. While tech stocks, particularly the Magnificent Seven, have had a significant impact on the index, it's interesting to note that utilities lead the performance, followed by industrials, real estate, finance, basic materials, communications, and even regional banks. Clearly, a wider range of sectors is contributing to keeping the markets buoyant. Now, last week, retail sales numbers grew at 0.4% in September, up from just 0.1% last August, and was better than the 0.3 expectations. Initial jobless claims came down to 241,000, lower than the 260,000 estimate. So far, the US economy also looking like consumers are going back to the shelves. Earnings continued last week as major banks reported very strong numbers. Morgan Stanley, strong financial performance, 3 billion in net income. Year-to-date efficiency ratio improved by 300 basis points. Charles Schwab, also strong Q3 performance, revenue up 5% year-on-year to 4.8 billion. Goldman Sachs, look at that, earnings per share up 54% year-on-year, net revenues up 7%. Wells Fargo, strong Q3 performance, 11.7% ROE with a 5 billion net income. Meanwhile, tech earnings, ASML's outlook was revised, revenue forecast lowered to 30 to 35 billion, and the next day, Taiwan Semiconductors pushing the markets up with its strong financial performance, also again driven by AI. Netflix earnings call, also strong financial performance, 15% revenue growth and 6 percentage points of operating margin improvement this year. For next year, they are projecting 43 to 44 billion in revenue, representing 11 to 13% growth. If we look at market breadth, financials absolutely roaring with 90% of the S&P 600 financial stocks at 10-day highs. Defensive sectors, basic materials, consumer defensives, industrials, utilities, all contributing to the market rally. Now, is the S&P 500 already overpriced? Is this a bubble? But if we compare the valuations of the S&P 500 in the last tech bubble and today, markets are actually up 38%, but is 19% cheaper. The AI growth story has priced the market at 26.7% PE ratio. So S&P 500, still some ways to go, and this could very well carry over to 2025. Going to the volatility index, this measures the fear in the markets. So it follows that when fear rises, the market tends to go down, and the greater the fear, the lower the market dip. But lately, the S&P 500 reaching all-time highs, while the VIX has spiked to above 20. And this is a very rare occasion. If you look at the stats, every time this has occurred, and this has happened 103 times in the past, the win ratio is 89%. That the S&P 500 forward returns in the next 12 months could be at around 18%. Meanwhile, is October truly the month for Bitcoin? Looking at the daily fund flows for the Bitcoin ETF, the daily net flows are at its highest in the last 4 months. Bitcoin on the weekly is forming a cup and handle formation. A breakout here means a measured target could be at around 119,000 in the coming months. For this week, earnings season continues. We have utility companies, Nucor, Next Era Energy. Airline companies will give us insights on the US travel markets. UPS might be an indicator for economic activity. Tech earnings continue with Lam Research, IBM, and Tesla on Wednesday. So watch out for earnings midweek, as these earnings will provide lots of liquidity for the S&P 500 this week. So still some upside room for S&P 500. Some divergences point to a correction in the S&P 500, but so far the market is still bullish here in the local markets. Hopefully, the good news in the Middle East last week can bring some life back into the markets. Looking forward to some earnings, there might be some issues that will go up, might be some issues that will go down, but overall the markets could consolidate in the next few weeks. Still, targets for a lot of analysts are at 7,800 for the rest of the year. We'll see how that goes. So that's it for this week. Please like this video if you found the information useful. Please subscribe to the channel for more updates. And again, good luck on your trades. Please manage your risk accordingly. And I'll see you again next week. Bye-bye.